Welcome back to the deep dive. Today, we are on a mission to really cut through the noise of all the financial gurus and market predictions out there.
Yeah, yeah, really.
We're cracking open a fascinating data-driven framework for building wealth that shifts the entire focus away from guessing what the economy will do.
And toward designing a personal system that just works.
Exactly.
Our source material today is, well, it's a very systematic look at saving, spending, and investing. And it's mostly drawn from the insights of a data scientist named Mikul.
And he's a COO at a wealth management company, right?
That's right. So his perspective is pretty unique because he spends his entire working life just swimming in client asset data. His advice is, really pragmatic. It's rooted in statistical reality, not just theory.
Okay, let's unpack that. The core insight here, the whole mission of his book, Continuous Buying, is that building wealth is about systemized action.
Continuous action.
Right. It's not about timing the market or finding the next perfect stock. The argument is that if we stop obsessing over the day-to-day market swings and just adjust our own behavior.
The rest sort of takes care of itself.
Exactly.
The shift is radical, but it's, I think, necessary. Instead of asking, is the market going to crash next month?
Which nobody knows.
Nobody knows. You're trained to ask, what automated action can I execute right now that I can actually sustain for the next 30 years?
And what I love is that this approach, it just immediately tackles the three big financial anxieties that I think plague almost everyone.
Oh, yeah.
We all worry about. One, should I save money or should I invest it first? Two, is it too expensive or too late to even get into the market right now?
And three, what is that vague, huge number, that net worth target I actually need to feel secure?
Yeah, that ghost number.
We're hoping to move you from that emotional guesswork into a real framework, one built on data, on consistency, and answering all three of those worries by the time we wrap up this deep dive.
So let's jump right in. The philosophy of continuous buying. Given Nichols' background analyzing all this client data, what does he say is the real engine of wealth for, the average person?
What's fascinating here is just the sheer power of time and repetition. The historical data overwhelmingly shows that when you buy is statistically far less important than two other things.
Okay, what are they?
First, if you buy it all. And second, if you continue to buy consistently, regardless of the headline.
So just the act of doing it.
The act of doing it, that whole pursuit of the perfect entry point, waiting for the market to bottom out, is statistically the most costly delay tactic there is.
Stop seeking the bottom. That is a hard psychological shift for so many people. So if we stop trying to predict things, we have to replace that habit with, what? A structure.
A structure. The source outlines 3 pillars of action to focus on instead, and they're designed to overcome that market anxiety.
Okay.
So the first pillar is about duration and quality. Long-term holding of diversified cash flow generating assets. We're talking broad strokes here.
So like index ETFs, that kind of thing.
Exactly. Think globally diversified index funds that just harness the long-term upward trend of the whole economy.
Okay, so that's the what? What's the second pillar?
The second is about automating the action. It's about removing emotion. So regular automated investing.
Setting up those automatic deductions.
Right. From your paycheck, from your bank account, you want to completely remove the need to check your mood or the news before you hit that buy button.
This is where the system protects you from yourself, really.
It does, which leads to the third and arguably the most challenging pillar. It's the psychological one.
Which is?
Accepting volatility as a feature, not a failure. I mean, the source makes this really strong, almost brutally honest statement. It says, if you can't accept a 50% market drop, you are not suited to be a common stock investor.
Wow. Accepting a 50% drop as just the normal price of admission, that really reframes the whole discussion.
It does.
So how does the continuous buying system help with the psychology of that, the impulse to just sell everything in a panic?
By enforcing action in spite of the panic. When you automate the purchase, you're forced to buy during those downturns, which means you're constantly lowering your average cost.
Right, you're buying on sale without even thinking about it.
Exactly. Volatility is, fundamentally, the entry ticket you pay for those better long-term returns. If you're consistently buying, a huge drop doesn't feel like a disaster. It feels like a systemic opportunity. And that clarity leads us to the next big question that fuels all that anxiety we talked about.
When to save versus when to invest.
Right. The author uses this fantastic light analogy to divide your financial journey into 3 stages, and it totally changes how you should view your goals.
This analogy is so important for figuring out where you are on your own journey. So at first, you're in what he calls the savings period.
Mm-hmm.
Your asset base is tiny. So saving more and increasing your income have the biggest impact on your net worth. Your investment returns are, pretty negligible at that point.
Right. If you save $5,000, your net worth goes up by $5,000. Simple.
Then you move into the transition period. Your assets are starting to grow. Let's say you have $50,000 invested. Maybe your annual return is $4,000, but you're still saving $6,000 a year.
Okay, so the effects start to even out. The new money you're adding versus what your existing money is earning.
Exactly. But the real breakthrough is the investment period. This is the goal.
This is when the expected return from your assets for the year is actually more than the new money you can manage to save.
And suddenly, compounding just takes over. The effectiveness of your investments just blows away any extra bit you could realistically save.
And this brings us to that incredibly provocative line from the source material.
I know the one you're talking about.
Saving is for the poor. Investing is for the rich. And we have to stress, this is not a judgment.
No, not at all.
It's purely a statement of financial reality. In the beginning, your wealth is all about your income and savings because that's all you have. But once you hit that critical mass, investment returns become the primary driver, the only primary driver.
So how does a listener actually use this? What's the actionable takeaway?
It's a very specific question you have to ask yourself every year. Is next year's savings amount going to be greater than my current assets' expected return?
Let's put some numbers on that, make it really clear.
Okay. Say you have $100,000 invested. You expect an 8% return, so that's $8,000.
Right.
If you can only save $5,000 next year, you are firmly in the investment period. Your focus has to shift to risk management and asset allocation because the market is doing more of the heavy lifting than you are.
And conversely, if your portfolio is only, say, $20,000 and 8% return is only $1,600, but you plan to save $10,000 next year,
then you are deep in the savings period. Your absolute top priority is earning more and saving more because that has way more impact than your market returns. That decision point makes it so clear. We have to tackle that savings period first, and the author's conclusion on how to do that is, well, definitive. Income determines everything.
It really does. And the reason high-income earners find it so much easier to save a higher percentage of their income isn't just about willpower.
No, it's just economics.
It's the concept of diminishing marginal utility.
Right. If your salary goes from $50,000 to $100,000, your rent probably doesn't double. Your grocery bill, your utilities, they stay relatively fixed.
The basic costs of living don't scale up one-to-one with your income.
Which means every additional dollar you earn has less utility. You already have the house and the car, so the amount left over for saving and investing, it grows disproportionately larger.
It's why trying to force a 30% savings rate on a really low income it's just mathematically brutal. But for a high income, it can feel almost automatic.
And this is why he rejects all those rigid, one-size-fits-all savings rules.
Like, always save 20%.
Exactly. The advice is to save what you were capable of. Be flexible. Save a ton more when you get a bonus, but allow yourself to save less during a tough month. The key is just persistence, not perfection. Keep the system going.
To give listeners a kind of compass, though, not a rigid rule, but a reference point, the source does provide some net worth benchmarks.
Yeah, these are helpful. They suggest that by age 30, you should aim for a net worth of about 1 time your annual income.
Okay.
By age 35, it's roughly 2 times your annual income. And by 40, you're targeting around 3 times your annual income.
And these are just guidelines, really, to see if you're on track to move from that savings period into the investment period.
Exactly. So the long-term task is converting what he calls your ability capital, your skills, your time into financial capital.
And the book lays out 5 distinct methods to do that, to actually increase your income.
The first has the lowest barrier to entry, but it's the least scalable. Selling your time or expertise. An hour is always just an hour.
Right. Then you can move up to selling refined skills or services. This is where you can build a brand and charge a premium. You're moving beyond just labor.
The third is teaching or sharing knowledge, which builds influence, a powerful asset. Fourth, and this one's highly scalable, is selling products, especially digital ones.
Like courses or software. High upfront work,
But the distribution cost is near zero. And fifth, the most practical route for many is internal competition and advancement within your company.
actively going for promotions.
Exactly. And it's interesting, he notes the average age of an entrepreneur is about 40. That's the point where experience and that accumulated financial capital finally meet.
Okay, so moving from earning to spending. The key here is intelligent spending, not, just depriving yourself of everything.
Right. It's not about being miserable.
And the author has two simple checks to manage that inevitable threat of lifestyle inflation.
The first one is brilliant. It's the twofold rule.
I love this one.
Yeah. So when you're thinking about a big purchase, let's say you want to spend $8,000 on a vacation or some fancy new gadget, you have to ask yourself one question.
Am I willing to simultaneously invest the exact same amount, $8,000, into a cash flow generating asset like an index fund?
It's a genius behavioral hack. Doesn't tell you no. It avoids suppressing your enjoyment, but it forces a dramatically higher savings rate.
Every fun thing you do now is directly tied to an investment in your future self. If you can't afford both, you can't afford the luxury.
The second check is the long-term satisfaction check. Before you spend, just ask, will this still make me feel satisfied or feel worth it 3 years from now?
And if the answer is no, it's probably just, fleeting consumerism. Probably should pass.
Yeah. The source also gives us a positive list. The 5 types of expenses that are most likely to genuinely increase your well-being.
Okay, the happiness-boosting purchases, what are they?
First, buying experiences. Travel, concerts, courses. Second, buying back time. So outsourcing chores.
Cleaning, grocery delivery, yeah.
Third is pre-paying fees, like an all-inclusive trip. It actually relieves the financial anxiety while you're on vacation.
That's a good one.
Fourth is spending on others. And fifth, and this is critical, occasionally rewarding yourself. You have to maintain the psychological energy for the long game.
Now, about that lifestyle inflation we mentioned, that constant danger of your spending rising with your income. There's a tool for that too, the 50% rule.
This one is so important for staying on track. When you get a raise, you have to allocate 50% of that net increase to saving and investing for your future.
And the other 50%, you can absolutely use that for immediate lifestyle upgrades. A nicer apartment, better food, whatever.
But, and this is a huge but, the author warns that spending more than 50% of a raise is actively postponing your retirement date.
Right. If you spend all of it, you're just running faster on that hedonic treadmill. Your savings rate doesn't actually improve. You're just pushing your finish line further and further away.
So we've set up the system, the saving rules. But why is investing mandatory? Why not just save?
It comes down to one really powerful, destructive force, the cost of holding cash.
Inflation.
Inflation.
Yeah.
It's the silent killer of wealth. I mean, if inflation is just 2%, your purchasing power gets cut in half in about 35 years.
Holding cash feels safe in the short term, but it is a guarantee of long-term failure. You are actively losing to the current of time. Investing is the only real countermeasure.
And there's a really powerful data point in the source to illustrate this.
Yeah, if you invested $1 in U.S. stocks between 1926 and 2020, that single dollar would have grown to $10,937.
That's just immense. But what if you put that same dollar in long-term bonds?
It would have only grown to about $200.
Wow.
That difference shows exactly why stocks have to be the growth engine. They're mandatory if you want to actually build wealth, not just tread water.
Which explains why a healthy portfolio needs two distinct parts, right? Each with a different job.
Exactly.
Yeah.
Stocks are the growth engine. They help you eat well.
And bonds are the volatility reducer, the source of capital for rebalancing. They help you sleep well.
You need both. You need the growth, but you also need the stability so you don't panic and sell the growth engine at the worst possible time.
So what about market crashes then? Should we wait for them?
No. The author says to treat them like a rare discount sale, but he is adamant you should not wait for them to start your system.
The math on recovery is pretty incredible.
It's exponential. A 10% drop needs an 11.1% gain to recover. A 20% drop needs a 25% gain.
But a 50% drop needs a full 100% gain just to get back to even.
And that's the opportunity. He notes that historical annualized returns right after a major market halving can be over 25%. If you have spare cash during a crash, great, a rare opportunity. But you can't pause your continuous buying system waiting for blood in the streets. You buy every month, period.
Finally, to let compounding do its thing, you have to minimize selling. The source lists only 3 acceptable, non-emotional reasons to ever sell your assets.
The first is rebalancing, usually annually. You sell the stuff that did well, usually stocks, to buy the stuff that did poorly, usually bonds, to get back to your target allocation.
Which forces you to systematically buy low and sell high.
The second is reducing overconcentration. So if one stock suddenly becomes 50% of your entire net worth, you sell some of it down to a safer level.
Makes sense. Stop loss.
And the third and simplest is just actual cash need. You need the money for a down payment, an emergency, or you're actually in retirement and withdrawing.
And outside of those three reasons, the rule is to just hold on and let the assets do the work. This brings us to the end game, retirement. The source reminds us that retirement is more than just a number, more than the 4% rule.
Right. Which, for the record, has historically worked for 30-plus years with a balanced 50-50 stock and bond portfolio.
But the discussion needs to go deeper than just withdrawal rates. The really critical question is, what will you actually do after you retire?
Yeah, the author has a big caution here. Achieving financial independence early, which is the goal of the FIRE movement, without a real, passionate life plan, can ironically lead to isolation and a loss of meaning.
Because work gives you more than just a paycheck. It gives you identity, social connection, a reason to get up in the morning.
Which brings us all the way back to the systems we've been talking about today. Wealth isn't the result of one single brilliant move or predicting the next crash.
It's the cumulative outcome of a lifetime of continuous automated action. And here's where we'll leave you with the final provocative thought from this deep dive. The ultimate principle is this: when in doubt, continuous buying and holding. So the question for you is, what single system or automated action can you put in place today, right now, to make sure you keep buying, to remove the emotion, and lock in the consistency that the data proves is the real engine of wealth?
Think about that twofold rule next time you're about to make a big purchase. Think about how you can use automation, not prediction, to get where you want to go.
A fantastic, actionable question to chew on. Thanks for joining us for this deep dive. We'll see you next time.